am a recovering banker. I had about 37 years in commercial banking, lending to medium-sized companies. I don't have a lot of not-for-profit experience, but the fundamentals of finance are indeed fundamentals. So what goes for a for-profit business is usually true for not-for-profit business. And what we want to do is dig into some of the basics of how financial statements are put together and what they tell us, how to use them as analytical tools to help you manage your operation, no matter what field you're in. These fundamentals do apply. So what good are your financials? That depends what you put into them. Financials are like a language. They have their own rules and their own codes, but they're pretty rational. They're a lot more straightforward than French irregular verbs, and you can glean a lot of information from them, and it's worth the effort to put into them. Because it does help you manage your not-for-profit to the best advantage and plan for the future of your organization. Yeah, why do they matter? Well, all of you have a mission. I'm sure you all have mission statements, and how you get to make progress on your mission is very much dependent on the financial health of the organization. It is absolutely critical. You can have the best of intentions and work as hard as you possibly can, but if the finances aren't in good shape, they will hold you up and can spell big trouble. Efficiency. None of you have a lot of spare cash jingling around in your pockets. You want to make sure that you're using the organization's resources to the best possible efficiency to get to your goals. Liquidity. We're going to talk a lot about that. How your activities translate into how much cash you have in the bank. And one of the first questions we always ask when we look at any of your grant applications, for example, how much cash do you have in the bank, and how does that relate to how much money you're spending each month? These are fundamental analyses that you always want to be looking at your liquidity. Profitability, which is definitely related to liquidity. Are you on an ongoing basis generating more cash than you're spending? You can occasionally get upside down on that and spend more than you're taking in, say for a given month or even a given quarter. But you need to keep a sharp eye on that, because if the burn rate, as we used to call it in banking, gets out of hand, then you get into a problem and start having to look at not achieving or not employing as many people or resources as you hope to. Solvency is another related concept. That's more of a balance sheet measurement of whether you have more assets than liabilities, and we're going to get into balance sheets in some detail here in a minute. If you don't have positive capital on that right-hand side of your balance sheet, that's a big alarm bell, and it's going to attract the attention of everyone who looks at the organization. So that's what solvency is. Credibility. You are interfacing with donors, with sometimes regulatory agencies, all sorts of constituencies that are interested in what you are doing. And clear financial statements are one of the best advertisements for how well your organization is run. If you are applying for grants, or you are putting together your Form 990 for the IRS, if you present a clear, easily understood financial story, that tells the audience that you're in control of the operation, and is one of the best advertisements you can have for your organization. So budgets, budgets are they're nothing more than a tool to help you manage your organization, but it's important to be rigorous in your approach to budgeting. It's a roadmap for your organization, and it's a benchmark against which you can measure your progress as you go through the year. A well-run not-for-profit, a well-run organization of any kind, has a formal budgeting process, which is put together by management, reviewed and approved by the board. And it really is the story. It tells the story in numbers of what you hope to achieve in the coming year. And then it gives you measurement along the way for how are we doing. And if we're going astray from budget, why is this happening? We'll get into quite a bit of analysis about variances to budget and the messages that are in there. So very simply, it's your projected revenues from all the sources that you have available or will have available against the expense structure of your organization. Most of you, I expect, it's salaries, but materials and it's possibly rent and all the stuff that all the bills you have to meet every month. So this really is the financial expression of how you see your mission for the coming year for your organization. And we'll get further into budgeting later. You won't add anything to that? Okay.
I think getting into your analysis would be awesome.
Okay. Good. Let's. All right. Well, let's get into the components of what go into a budget, what go into the financial statements of an organization. And we always start with the balance sheet. The balance sheet is a static picture of where your organization is at a given moment in time. It shows your position, your assets, your liabilities, and your capital or your net assets on that particular date. What are assets? Assets are anything you own, and we'll look at different classes of assets when we dig into the balance sheet. Is what you own. It can be cash, it can be accounts receivable. In some cases, it can be equipment, automobiles, computers, possibly real estate. Some of you may own your own buildings. And that is set on one side of the balance sheet. On the other side is what you owe. What you own versus what you owe. Liabilities are what you owe to others. It could be rent payable, wages payable, all kinds of obligations that any entity might incur. And by the way, we sometimes think of assets are good. You know, I'm an asset to this organization, and we think of liabilities as bad. That's not necessarily true. In some ways, as we'll see when we get into a balance sheet, when assets are growing, they're actually consuming your cash. When liabilities are growing, they may be a source of cash. All of this needs to be watched and controlled, but there's no moral character ascribed to an asset or a liability. Then the difference between the assets and liabilities are your net assets or your equity or your capital. And that is your net worth. That is, if it's a positive number, you're solvent. If it's a negative number, your organization is not solvent. So why don't we move on then? So I think you all have a copy of this sample balance sheet for a really great non-profit organization. It's a pretty straightforward balance sheet, and what I would like you to do is take a minute or two and just kind of look at these balance sheets. This is I guess this organization has a September 30th year end. We have last year's and then the most current year, and they're set side by side. Take a look at that for a minute or two and see what jumps out at you. I'll just talk for a second about how a balance sheet is organized. Your assets, the things you own, are up top here, and they're in an order that is sort of the accepted way balance is put together. Cash is always at the top. That's your most liquid asset by definition, and then kind of in order of how liquid or how readily converted into cash an asset is, that's how they are set up on the balance sheet. So investments are basically cash that's tied up in some sort of instrument. It could be that you really don't want to invade that too quickly, because if it's a certificate of deposit at a bank, you might incur a penalty. So they're not quite as liquid as cash, but they are, particularly in times of possible emergency, they are available to be cash. Accounts receivable are what your people you're dealing with owe you, and presumably that will turn into cash in a reasonable period of time. Likewise, grants receivable, prepayments, that's a very small item. And all of this are considered current assets. A current asset is an asset that can be expected to be converted into cash within a year at the most. So they are your more liquid assets, closer to cash. And then the less liquid assets, of course, are further down on the balance sheet. You've got land, long-term promises, and some long-term investments in this case. You add that up, you got your assets, and then through the miracle of double entry bookkeeping, we have a exactly balanced total on the other side. And here your liabilities are similarly classified into current or longer term, depending on how soon they are likely to have to be met. So accounts payable are usually due within 30 days. So those are pretty current. Some other accruals could be rent payable, whatever it may be. Money, short-term money, if you borrowed it, it would be current. And then if you have long-term debt, there might be a portion currently payable that is within the coming year, and that's still in current liabilities. And then so your current liabilities are the ones that must be met within the year. The current assets are available to you within the year. You compare them to each other, and down here you get what's called a current ratio, simply the ratio of your current assets to your current liabilities. The higher the ratio, obviously, the more liquid you are. And then your difference between all your assets and all your liabilities come down here into capital, which maybe capital you accumulated through fundraising or through making more money than you're spending, profit. Some of the capital you've attracted as an organization may come with restrictions, and some is unrestricted. That's usually separated. So, what jumped out at you, or question?
I have a question. I was wondering about the other assets with like land, automobiles, things like that. Are you just putting in like the current market value of like, if you sold that item, this is what it would sell for? Or like, what do you put in there?
No, you're not allowed to do that.
Okay. What do you-
You put it on the balance sheet at its original cost to acquire it. And then if it's a depreciating asset like a car or a building, each year a value is taken off of it over its useful life until it's depreciated down to zero. You are not allowed to mark up and nor must you mark down your long-term assets. It's
That's why it stayed the same. Like I noticed year to year, it was the same. It just, that's the original value.
yeah, that's exactly right. Your observation is correct. It is on the balance sheet for what it costs you to acquire it in the first place. Land does not depreciate, by the way. Building and equipment does depreciate, so we can go down in value. Here it went up in value. There must have been some capital spending done on equipment that caused it the balance to go up. But when your accounting system or your outside accountant changes these values, it can only be for money that you actually spent on a fixed asset and then the depreciation that takes place over time. Yeah, you cannot mark up your assets to market. Companies sometimes try that, but that's not generally accepted accounting. Yes.
Maybe a dumb question, but
Yeah,
are there other, as opposed to like net assets, are there other, like, is there other terminology that you might see in a balance sheet? That like, so for ours, for example, I have like total equity, I don't like, but versus like a line that shows net assets specifically. So I'm just curious if those are synonymous.
Two things. First of all, is the only dumb question is the one you don't ask.
Great.
Okay. Please don't be inhibited. And secondly, yeah, accounting is a language, and like most languages, it develops all kinds of idiomatic usages, and it can drive you nuts. Net assets, capital, equity, owner's equity, those are all the same thing. Just different words for the same thing. There's lots of flexibility as long as you are clear about what you're expressing. So, really, the use of a balance sheet, the best usage of it is to look at trends over time. Look at what has changed, because that's telling you what's going. Can give you quite a bit of a clue about what's going on in your organization. So, what jumped out at anyone in looking at balance sheets? Yes.
Line of credit.
Yeah, they did not have one the year before, and now they do. Now, is that good, bad? We don't know. There's nothing necessarily wrong or right about it, but it does raise the question of why. Why did the organization borrow $15,000 over the course of the year? And we'll get back to that because there's a story there about what's going on. Other variances, changes, trends that jumped out?
I've got a question. It's not related to that. What's this promises to give? Could you go into detail what that means?
Your organization received a promise from someone or something to donate money within the next year, and the way the accounting works for that, is that you are allowed to say, yeah, now I've got something real here. I'm gonna put it on my balance sheet. Looks like it went up about $6,000.
So how real is that? I mean, it's, we're talking about fixed assets and
So some of these are tangible assets like a car or a building, and a lot of them are intangible, and a promise to give. Or another way, it would could be called a grant receivables, another category. These are formal promises that your organization has received, and if it's well documented, yes, it is proper accounting to say, yeah, I own that promise, and I believe, and I have grounds to believe it's going to be received, and there is a balancing entry that goes into your capital.
so does it have to be on a contractual relationship?
So a lot of times, like we've done a capital campaign, and this is that you actually have like soft promises to contribute to your capital campaign. So, you know, you can book that as revenue at the time that the promise comes in. To be contractual, it means that if they promise to give, you know, let's say $100,000 towards your capital campaign, and you're relying on that $100,000 capital contribution to be paid. And everybody else is relying on that, the bank and other, you know, contributors, and they do not come through. Would you go after that promise to pay? It's a promissory note. They promise to pay. So most soft pledges in a capital campaign, you know, is like, are you going to go after a donor that, you know, says they're going to contribute something and they don't come through? And that would be on your pledge documents, whether it's a, you know, a soft pledge, or you're saying, we're relying on this, we're going to the bank, you're promising us this money, because we're going to the bank to get a loan, and if you don't, you know, come through it, would you go after them? Okay, and that would be a hard promise to pay. But most promises to pay are recognized as revenue at the time of the promise.
If they're contracted, if they're not enforceable, you're saying, Karen, you wouldn't put it in.
But we still book them as at the time, but as a receivable, you know, a promise to pay at the time that they were incurred, whether they're soft or hard.
We booked our soft pledges.
Yeah, they are booked.
Can I give you just a really quick, simple example of this? Colorado Gives, we get notified every time a donation comes in. So at the end of December, I show I don't call it a promise to give, I call it a donation pledge. We haven't got the cash until January. I want to show that we have the asset. And when the cash comes in January, I relieve this account and move it to cash. So that's just a real simple example of a promise to give. I know it's going to happen because somebody's credit card's already been charged for it, so.
So it's a gift receivable or.
Yeah, pledge.
That come in, but pledges aren't necessarily even received. They just say within this 3-year period of time, I'm going to contribute X number of dollars. Do you recognize that at the time that the pledge was? So that is something to, you know, to discuss with your accountant and your financial advisor, whether you're going to book those at the time. And because if you most of them sign, you know, let's say, I will pay this, you know, over 3 years, and you're relying on these capital campaigns. But it's, as a nonprofit, is that good business to go after a donor that doesn't pay, you know? But if
I guess outside of the accounting realm.
right, so there's two things: the accounting realm, and the other thing too is that there's a contractual obligation. Is soft or is it hard?
It goes into your capital when you get the pledge, and then as you say, when it's received in cash, yeah, then you decrease the promise or the grant receivable, and it goes up into cash. Yeah, it's kind of one of the useful ways to look at a balance sheet is to ask yourself, what is the impact on my cash from some of these different changes? So, you know, for example, your accounts payable went up a couple $1,000 over the course of the year. That's actually a source of cash. well, it's cash you didn't have to spend yet, but you got something for it. Other changes to look at, it was, we looked before at, the building component went up. That means that capital spending took place. That was a use of cash. And all of that gets reflected in your cash balance. Your promises to give went up quite a bit, but it's not cash yet, as we were saying. Well, let's get back to this line of credit, because that's kind of the big item here. Why did the entity, the great, really great not-for-profit organization borrow this money? What happened? What was the purpose of that?
This that their liability numbers are going up in the 2024.
Their liabilities did go up, but. And it is the main component of those liabilities, but that doesn't tell us what happened to the cash. Where did it go? Look at the difference in the capital account. About $15,000. Not necessarily a terrible thing, but it requires analysis, and it raises the question, what's going on here? And when we get into the income statement for this entity, we'll find out more. It would lead you to ask what happened in the course of the year, which is told to you by the income team, that led to this borrowing. And this capital account going down, that's usually a bit of a red flag. So it raises questions, and that's the purpose of doing this analysis, is to get all of you asking penetrating questions to your own management teams about what happened, what's going on here. Maybe the really great nonprofit organization isn't great after all. We'll see. Let's move on. So the income statement, if you think of the balance sheet as a photograph of a point in time for your organization, and you're comparing photographs, this is the motion picture. The income statement is what was flowing through your company or through your organization that led to the balance sheet changes we were just considering. So it's over a period of time. And again, the accounting terms there are a lot of interchangeable terms. It can be called a statement of financial activity, profit and loss statement. That's kind of an older school way of referring to it. A P&L, income statement. All of these are the same thing. So it's over a period of time. It's the year-to-date activity. You could be looking at a 3-month income statement or a 12-month income statement. It's all the flows of cash and other activity that took place in your organizations. And here again, comparisons of actual to budget and comparisons of actual to what did we do last year are what give you information about the organization. So let's look at an income statement for the very same entity. And you'll see the way this is laid out. This is a good format for your statements to be put in. So here you have the whole year budget that was created before the year started, approved by your board. This is our roadmap. This is where we think we are going. Over here is what have we actually done year to date. I guess this might be a 9-month, must be a 9-month income statement. The budget that is next to it here is what we expected to happen over that 9-month period. And then the variance is the difference between what we did achieve and what we expected to achieve. And it's also instructive to look at, well, where do we think we're gonna be by the end of the year? So again, take a couple of minutes to look at this and see what jumps out as significant to you. What are the things that are striking to you? Yeah. Yes.
Big reduction in two grant sources up at the top.
Yeah, and here's the story here in the variance is that you always want, what's helpful here is variance analysis. What happened that we weren't expecting to happen? And what is that telling us about the organization and how might we need to change course? Whoever the fund foundation is, was expected by now, year to date, to have been a $50,000 source, and only 15,000 has been received. Now there's all kinds of reasons that could be. Maybe there was just a delay in time. That's not unusual, but it's something you need to understand. So again, the purpose of these statements is to get you asking the right questions about what's happening in your organization. Both of these are significant variances that really beg to be analyzed and understood. Yes.
Would there, for those two examples, would there be a way, let's say that the fund foundation doesn't deposit until Q4, since this was on September 30th? Would there be a way to demonstrate that in the budget to know that that income is coming in? By the end of the year?
Well, you had the expectation, it hasn't been met yet. There could be perfectly good reasons for that, and maybe you have good reason to think that it will come in. When you don't want to change your budget around, that should be sacrosanct, because it would lose its value as a roadmap if you were changing it. But it's telling you that something didn't happen the way it was expected. So you want to get the answers to those questions. Was that what you were?
I don't think you put it in the numbers here, but this is where, like, if you were presenting this to your board, you would have some notes at the bottom here and say that, the reason this variance is that, we were told the money, it's on its way. We should see it in the next, 30 days. So these would be notes to your variances that would explain it. You know what I mean? But if you didn't have any notes on this and you presented this to your board and they didn't ask you that question and you weren't prepared to answer it, then yeah, so that's the red flag. So just to put these notes as to what, may or may not. And it could have been that you applied for the grant and you thought you were going to get it, which happens, and all of a sudden you find out it's not coming. You know what I mean? So that would be also showing up as a variance, and you would just have to note that we were denied the grant that we had planned on. But not changing your budget to say, okay, well, we projected it now, which is.
Yeah, that's a valuable way to go about presenting this to your audience, your board, or whomever. You can kind of put a number here, or a footnote, or just a little statement, explaining what happened on this line, so they see that you're on it and you've analyzed it already, or at least it's an open question. Any other things that kind of jump out here? You've got a almost $24,000 shortfall year to date in revenue, and we see where it came from. Some grants have not gone through. So what's going on in the expense side at the same time? Yes.
It looks like the expenses are underrunning year to date, and the main driver is they're not giving grants to others.
Yeah, there's some response here to the lack of revenue is to stop spending as much money as your budget anticipated. And in this one category, there's almost $7,000 that's been saved. But it doesn't come close to meeting the revenue gap. And
Should look familiar to us.
at the bottom line, you're 17,000 behind budget. And instead of breaking even essentially, which is where you expect it to be, $63 profit, you're in the hole. You have a loss, a lack of profit to the tune of 17,000. And that would appear to be where the loan came in. There's all kinds of reasons to borrow money. By the way, nobody wants to borrow money. As a lender, as a commercial lender, I was never under the people were coming to me because they wanted to. They were asking the bank for a loan because they needed it. When I was a young banker, a more experienced banker told me, lending is fundamentally an adversarial relationship. And I went, what? No, we love our customers. We want to do more business with them. Fundamentally, it's not something some people want to do because they need to do it. And in this case, the need was to cover a loss, which, there's all kinds of other reasons to borrow money. You could be borrowing money to acquire fixed assets or to fund the growth of the organization, hiring more people, generating more revenue that's not cash yet. But borrowing to fund losses is a real red flag. And we've kind of highlighted, some of the components that led into this. So, yeah, you didn't cut your expenses as fast as your revenues were falling, and the difference was made up by a loan. That might be okay because it could just be timing differences. All those fund foundation grants really are going to roll in the fourth quarter. We have good reason to believe that, and we'll pay the loan back at that time. But you got to be sure that you're on solid footing when you make assumptions like that. Otherwise, whoever lent you that 15,000 is going to come asking the questions of you. Yes.
So as a banker, wouldn't I say you've got $258,000 of donor without restrictions? Why don't you use that instead of a line of credit?
The capital account reflects the net activity of your organization, but it doesn't. A capital account cannot be just converted into cash. It's really a historic look back on where we got our cash or where we got our promises of cash. But the pressure point is really up in the assets. How am I going to convert that long-term asset into cash? The existence of the capital of a positive capital balance does not in itself indicate that you can create the cash. So it's the difference between solvency and liquidity, I suppose.
Well, put it another way, then we've got 72,000 in current assets.
We've got 72,000 in current assets. Yes. You should be, if all of those assets convert into cash, you should be able to cover those liabilities. But it's it hasn't happened yet.
So why would a banker do that? This is kind of, my question is, why would the bank give money to an organization that?
Why did they lend the 15,000 in the first place? Either it had not become apparent yet that the donations had not been received as expected, or there was a good explanation for that, and the bank said, okay, you have a track record with the fund foundation, you tell us they're really in the fourth quarter, they're really going to give you that cash, we check it out, we believe you. It's credit. Granting credit is an act of faith. The word credit is from Latin credere, meaning to believe. But it's a wonderful thing because it creates liquidity that wasn't there before, based on the belief that the credit is good. And without credit, this economy would grind to a halt. But it's a bit like prescription narcotics. In the right dose, given for the right reasons, it can be a miracle. In the wrong dosage, or for the wrong reasons, it kills the patient.
Chris, if I were to go back and just look at the balance sheet, when they got that $15,000 line of credit, it shows $15,000 in liabilities, but at the same time, that would have increased presumably my cash by 15,000, right?
Where did it go?
Well, I guess I would say if that 15,000, if they hadn't got that, then your $25,800 in cash equivalents would be $10,800, right? And if you compare that with your current liabilities of 7,000, you're getting, your cash flow is getting really tight on that particular date. And I don't know, to my mind, it's easier to see that as a driver for getting the loan rather than, you know, things not matching budget. I mean, not matching budget is important, right? But coming back to cash flow, those are checks you might have to write in the next month, and your cash balance is going to be within a couple $1,000s of you being able to keep your credit card or your checking account functional.
Exactly. Yeah. Those are two different ways of looking at the same problem. The organization's, it's losing money. And that will express itself in what you were just saying, Kurt, that it will start to eat into your cash to the point where, yeah, you're going to have to make some quick changes. It's really a different angle on the same problem. All right. Well, so the point here is pretty basic, is that there are messages in these financial statements that are important for you to be paying attention to. And so this leads to a discussion of what's the best practices for your financial statements. Most importantly, you got to get your monthly books closed promptly. You can't be waiting around for 6 or 8 weeks to know what happened the month before, because you're already looking in the rearview mirror. You don't want it to be miles behind you, because that will cut into your reaction time to any problems or difficulties that are apparent in the financial statements. I feel like by the 15th day of a month, you should be able to look, your board should be able to see what went on the prior month. That's fairly quick, but doable. In my loan agreements, I required the statements within 30 days. That is, by the middle of the month, I would think internally there should be a review going on in the organization for how we did last month. And then by the end of the month, it should be presented, if you had a loan, to your lender or to your donors or to whoever your audience is. And I certainly found that without a doubt, late financial statements never have good news. The good news came quick, the bad news tended to dribble in. And that's, so it's a red flag to your own board if your organization cannot present its financial statements by the second half of the following month. And there should be a rigorous and regular review process. First by management every month, looking at how we did the prior month and year to date. And then it should be ready for the board's review by the end of the month. And there should be a formal board review of your financial statements on a monthly basis. It might be a very quick review, maybe nothing really out of the ordinary happened. Maybe there are hardly any variances to budget, fine, but you know, it needs to be looked at by the board. That's absolutely integral to the board's duties. What's the right amount of cash to have on hand? Well, it varies from one organization to another. It depends on you know, how many fixed costs you have to meet. But generally having 3 months of cash on hand is considered to be a pretty good measurement. When we review grants here at the Community Foundation, we are looking at how many months of cash you have in the bank. If you have 6 months, that's great. If you have 3 months, that's pretty good. You have 1 month, not so good. Because it just gives you very little wiggle room for anything to go astray from what you're expecting. And as Karen was pointing out, since these financial statements are full of clues and messages about how your organization is doing, pinpoint those and describe them as a management team, describe them to your board so that they see, sort of anticipate their questions and they see that you're on it. You have already done the analysis. So that these are best practices for preparing and using your financial statements.
So 1 month or 2 months or 3 months of cash on hand, what if you have 24 months of cash on hand? Does that decrease the odds of getting your grant?
That's a good question. It's say, well, what are you planning to do with it? I think
That's more important than whether we can self-fund.
right, that if you're just like, you're making so much money, you know, you should be putting it back into the community to fulfill your mission, you know, and or you're planning that to be for a future campaign, expansion, growing your organization. That should be noted versus just saying we're stockpiling cash. Because we're great at what we do, but you're not really doing as much as you can do. I think it would be, I would look at that, say, you know, and we have seen that. It's like, what are you planning to do? You know, why is it that you're asking for more and more money, but you're not putting it back out? Stuff. And so, and those questions usually lead to some answers like, well, you know, we have this project because the building's slipping and we need to put in a retaining wall and, you know, we're trying to get enough money and, you know, so, you know, or a new roof or things like that. So it kind of explains why they're stockpiling the cash for some improvements. So just to earmark that would be good.
So we should explain what the excess cash is for.
It would be helpful because I'd ask.
Sort of on that same point, 24 months, right, is sort of a, maybe for some people, maybe not, an exaggerated example. Like, is there a certain point at which those questions start to arise? Is it a year of reserves? Is it 8 months? Like, at what point
I
are
think it
you
would
all
be
like
more than
starting?
if it was the first time you're applying for a grant and you've got 12 months of operating reserve. I'd probably say, you know, hey, what's your intent? You know, what is it that you're doing? And to ask more questions about, you know, what are your plans? You know, especially if you're applying for a competitive grant round, you know, competing to get others that have very little.
Yeah, I think it also is depending on whether you're applying for general operating or program grant.
Right, yeah.
You know, it may be totally justifiable for you to be applying for funding for a program grant and have a big reserve, but if you're looking at general operating, the question is gonna be, why aren't you funding yourself within?
And how do you, sorry to monopolize, I don't know if other hands went up behind me, but in circumstances where you are sort of reinvesting some of your reserves back into your mission, how do you, I don't know how to phrase what I'm trying to ask, but I feel like we're often in this cycle of like, well, how did we do last year? And is it gonna reflect poorly on us if we show a deficit in the coming year? And so if we have a really successful year fiscally, and then we take some of that and invest it in some initiatives, but perhaps that puts us at a deficit at the end of the coming year, that
Right.
how is that just something you want explained in the notes? Like, in what way do we show that financially so that it's evident that we're effectively using the money that's been gifted to us from whomever?
And so it's gonna show up, as you would say, like using the term, your current earnings are gonna
Yeah.
roll over into retained earnings, which is net assets.
Yeah.
You can actually line item and say that we're gonna take some of our surplus
Yeah,
for the current year, and we're going to apply it to growing the organization, whether it's a new initiative, a program, adding staff. So it would be a restricted surplus for the following year. So yes, so it could be like, you rolled over $50,000, now you're expanding, you're gonna have to make some improvements, new equipment or something, office space to hire somebody. And so you might show a $30,000 current loss, but it's against that. So a current deficit of 30,000 against, say, prior surplus. So those would be things that you would have to just either note, and some accounting systems can track that.
okay.
And we do that here at the foundation, that if we do have a surplus at the end of the year, we'll either use it to fund our current budget, some of that, or we'll use that to put into the excess into our growing our operating endowment fund or something. But sometimes, yeah, we use our surplus from one year to balance our budget. And then, if we had a negative surplus, or excuse me, a deficit that current year, it was against, surplus. Yeah, so you just have to note that or track that somehow.
Yeah, and here's where, I mean, if you had actually budgeted to have that surplus, that would indicate this is part of a plan. If it was an unbudgeted surplus, well, that leads to the question, what changed? Again, not bad or good, but what's changed? That's really the purpose of these statements, is to give rise to penetrating questions about the organization. Asking why, always why did this variance to budget or variance to last year occur? There should be perfectly good explanations, but it's the explanation that's being sought. It's an analytical tool.
How do in-kind contributions get recorded, or do they get recorded?
You see those.
We didn't see those. So I guess it would depend on so a stock gift is an in-kind contribution, but it converts to cash. So, I mean, so are you talking somebody donates an asset like a car or land?
It could be
or
people's time too, what we've seen.
But we can't book that.
Yeah.
But I mean, but it could be like it's somebody gives you something that you can't convert to cash right away. So if they gave you a car, it would show up as an in-kind gift until it's converted into cash, or it becomes an asset of the organization. Okay, and that's a whole tricky thing of valuing, especially cars.
So advertising promotion.
So that would be so I guess this is where on the other side of it is that, so you have a vendor that says to you, I will give you $5,000 via free advertising coverage. Okay, so you want to say, well, great. So you can book that as an in-kind contribution, it's $5,000 for media, and offset a $5,000 expense that you would have had to incur. Okay, now, does that vendor that gets into things, do they want a receipt? Or they're just gonna write that off as, a loss, and that's their deduction on their side. But they could, we've seen that a lot too. I've looked at some larger financials that they'll receive a lot of marketing for free. they'll show it as an in-kind marketing and an expense for marketing, so it's offset.
On the income statement.
On the income, yeah. So it'd be an in-kind, but it would be clarified that this is a marketing in trade of, you know, whether it's print media or, but it could be somebody that gave you an invoice and they said they will donate that. You know, so that's the tricky thing of what they're donating, because they can't donate their time.
So how do we budget for those?
And you can budget for it if you know that they're gonna give it to you. It's no different than somebody saying that I'm going to give you or pledge, you know, a cash donation. You know, are they going to pledge that they're gonna give you marketing, free marketing? Yeah, you know, so you can still book that, but it's gonna be offset by an expense.
April, you had a question?
Yeah, so on our income statement, we always book our in-kind rent and vehicle maintenance for our shuttles so that's a city and county contract. But we have it as expense and income, so it just offsets.
Right.
Should be tracked that way.
Yeah, yeah. Mhm. Yeah, no, absolutely.
If you didn't budget for it, but you received an in-kind gift that wasn't budgeted for, but it's like, it wasn't an expense or an anticipation.
It's still a benefit, because if it's an in-kind gift that you're going to use. You know what I mean? So let's say that you're paying for, you know, I'm just using media, like, you're going to pay the pilot lots of money to run an ad, you know, and they gave you an in-kind. Okay, so you can say, they gave me this ad for free, I was gonna pay it anyway, so instead of it coming out of my cash and expensing the $1,000, you just got an in-kind, they gave it to you. You're still gonna show that you used $1,000 expense of advertising. So it's still gonna net zero. But you wanna track it, it was a benefit. It just didn't convert to cash.
So on the expense, should there be a specificity as to the in-kind designation?
I would say like April's, you know, it would for the rent and maintenance and stuff like that, that would be very beneficial. Because like I said, at some point, if let's say that in-kind goes away, you have a record of what it costs. Or what your actual expenses are for what the rent would be, what the maintenance would be, but you're getting it covered through an in-kind contribution. So yeah, I would earmark it specifically like that. Or, you know, it's smaller, not one classification, but.
If you knew it was coming, you would have budgeted it, but if it's unbudgeted, then that, again, that's just a variance that requires a full analysis.
Right, so your budget would increase, but yeah,
Nothing wrong with it.
yeah.
For our online participants, if you have questions, please don't be shy about raising your hand or unmuting to chime in.
I have a question. So Tim, you were saying with reserves that if you're applying for a general operating grant, it might be a question, but if you're applying for a project or program, it wouldn't necessarily be.
I think
Why
it-
is that? Cause like, couldn't you also say the same thing about the project? Like, why don't you just fund your project with your reserves? Or like, why is it?
Yeah, I mean, it's also case dependent. I can imagine you applying for a project grant and wanting the foundation's endorsement, which is why you're applying for a grant, not necessarily that you need the money. I mean, there could be all sorts of conditions or circumstances. So I think what I'm hearing from these guys is that if you do have a big reserve, 24 months of, you know, operating, it just raises a question, like, what's your plan? And that's all. So I don't think there's like hard and fast rules around that. Because it's kind of unusual for a nonprofit that much reserve, frankly. So.
I wanna know how you're doing it.
I think I thought Karen made a really good point. If you've got that kind of reserve, why wouldn't you be growing the organization, you know? Or doing something, like building a building, hiring staff, starting new programs, whatever.
Yeah, I had a question about those grants. We're using the basic version of QuickBooks Online and it doesn't have passes or fund accounting. So we received a substantial grant this year that puts us beyond the Form 990. This for the first time. And is it, I don't know, appropriate might not be the right word. So I have a revenue for the grant. Should I book or could I book the offsetting expenses as a contra revenue? Or,
So you want to track, yeah, that's a kind of a, yeah.
yeah, that allows,
Classes or locations in QuickBooks, it's really hard.
yeah, that would allow me to show the board the
Right.
grant and the expenses that offset it in a very succinct way. And it might get us below the requirement for the 990.
Well, it's based on revenue or assets too.
Mhm.
Yeah, so.
Well, let's say it's revenue and expenses or contra expenses.
So, it would, I see, oh, I see what you're doing.
Yeah. In the income statement, we're gonna have the grant and then we're gonna have a contra revenue right below it.
Right, but if you're throwing over the $200,000 revenue margin, you have to follow your, the 990, and then you're saying really it's only 150,000 because that's. Yeah, that's great, but I don't think that's appropriate because it's revenue. You know what I mean? So you have to book your grants, and it depends on if it's grants or donations or whatever it is, and I'd have to look at those requirements.
Yeah, it would only be for grants that are
Offsetting them.
restricted.
And if it's not a pass through, that's a different thing, and I don't wanna get into the, this is not tax advice or anything like that or financial, but. If it's, some revenue isn't counted, but, you'd have to be careful by just saying, because it's an expense. Yeah, I mean, it's okay for you to track it that way in your system without going and adding, more less version of QuickBooks to use classes and locations and things to track all that. But it's revenue.
Can you give us a quick definition of pass-through revenue?
So pass-through would be something like, we facilitate a lot of pass-throughs. Somebody, is wanting to pass through a stock gift. So we accept a gift of stock, we give that donor the tax receipt, and then they designate that to go right out to another nonprofit. So it passes right on through. So if you receive something that's coming through you to go right out the door, to cover a specific, that could be considered a pass through, but if it's coming to you and then you're deciding to use that money because it's unrestricted to.
On your pass-through, where do you put the debit? Against the same revenue account?
No, we just track that income as a pass through, and then of course it's a grant, so it's still revenue. It's noted in our audit. We remove the pass-through donations and offset the pass-through grants. So we do track those if it's directly passed through us. And there is some rules that I could give you that actually describe what a pass-through is.
That sounds like what we're doing. We got the grant for a very specific reason. And I believe we're going to refund any surplus.
Okay, and it could be, and maybe I'll make a.
Yeah, well, I'll get with you.
Yeah, and then we can follow up on. Could be a pass through.
To the extent there's a timing difference, though, it seems like it would show up on your financials
It's,
at different times, because if you bring it in this month and it doesn't go out till 2 months later, even though it's a pass through, but you're waiting on an invoice or whatever
yeah.
I just need it sorted out for year end for the 990s.
Right.
We just put it as an unusual grant.
It could be.
Yeah. And I'll look into get that.
I mean, in this, this is an interesting question, because if you've got a grant and then you're just gonna do it for your, spend it on your programs, that doesn't look like a pass through to me. The reason we have these pass throughs is because we are providing a service to the donor and just basically turning their stock into cash and then giving it to another nonprofit. It really isn't it's not like it's a normal grant for us. It's just.
I guess another example would be is that, let's say a foundation wanted to do something to the community through a non-501c3 organization. Okay, and so like the school district or, housing authority or First Impressions, which is run under the county. And so they go to the nonprofit and say, hey, would you, accept this grant from this foundation? And then because your mission is in line with that, and you're gonna just pass it right on through to that organization, whether it's childcare, housing, or something like that. So that would be a pass through. You're just accepting that and passing it straight on through to another organization because the foundation or whatever does not want to or can't donate directly to that, a non-501c3.
Well, we basically contracted with Rocky Mountain Youth Corps to do work on our behalf because they have employees and we're a totally volunteer organization. And we don't want to get into employees and payroll taxes, and that really changes things. So we got the grant, we're going to fund them to do a certain amount of work that we have specified. And my understanding is if they don't spend all of that money, we're going to give it back.
Yeah.
So this sounds like a pass through. It is a 501.
Contracting them without having to incur those costs directly. You're still contracting Rocky Mountain Youth Corps. So I'll look, let's look at that. Cool.
Well, we do have a hand from Meg.
Hello. I was just wondering if you could review the best practice for accounting for when you are using your reserves to fund a growing program.
To fund what kind of programs or
When you are when you've budgeted to use your reserves to grow a program or to grow the organization, how is that best represented on the financials?
If you have the surplus sitting in your cash and it's earmarked, you can be spending down your cash. And you budgeted to increase your, growing your organization or growing that program. Really is just saying, where's that increased budget is coming from? Where's the money coming from? So I don't know if you can actually track it on your financials. You're just reducing your reserves to fund your cash.
It would be a budgeted use of cash.
Budgeted use of cash. But if it's depleting your surplus, by, you're not keeping that, 3 to 6 months, then it might want to just be noted somewhere.
Well, if you're budgeting a decrease in cash, there's got to be an offsetting entry. And that could be, you might have created a liability that will be relieved, or you're going to relieve your capital account, your restricted capital account.
But I think it's just that your reserves are growing because you have a surplus. And so over time, you want to put that surplus back into your organization by growing your program, your staff, or your resources. And so it's just a use of your cash.
Yeah, they'd be budgeted decrease in cash, a budgeted decrease in capital.
Yeah.
So reserves and capital, those aren't the same, right? I had that question earlier when you're talking about, you can't just
I
do
used to have a
capital.
boss in the bank who said, I don't really look at financial statements that hard. I just look at cash and capital. Which is not a bad place to start when you're looking at a balance sheet, but capital and cash they're different. You could have plenty of capital and be totally illiquid, depending how you're managing your organization. But in the example that we were just talking about, where capital had been raised and accumulated in cash, and now we're going to use it. Yeah, you would just, again, you always have to have the offsetting entries. Cash goes down, capital goes down.
Okay,
Or cash goes down because you have a capital, you bought a building or something like that. So that's the use of your going from cash to capital. Okay, because now it's not liquid.
It's a different asset.
Right, there's still an asset, but it's just moving your cash to buy something, whether it's vehicles or. Larry.
So under the current assets, we have this thing called investments. What would those kinds of things be?
So under that, let's see on the balance sheet, is that investments? Well, that's probably just putting, so your cash is sitting readily available in a checking account, or you have it at least in an interest bearing account or some revenue. If it's just an investment account, it could just be an interest CD or whatever it is,
Right.
you know, it's just. Yeah, there is an endowment on that deal, which is differently, that's a donor restriction, that is permanently restricted asset would be an endowment. That is an asset to the organization, but it is restricted.
I'm not sure I understand. So it's it's under the current assets.
Above, that's a 17.
I think it's regarded as current because you can get at it in the given year if you need to.
And I suppose it even if,
It's at that time and point.
right, it's at the time and point, and you know what, if the investment was, you know, in a portfolio being managed by something like that, whether they called it, you can still get access to it and convert your.
So it wouldn't be long-term then?
No. No, you know what I mean, cause you can say, you know, we have it invested at Wells Fargo in the, you know, in a mutual fund or whatever it is. And you can still call them up and say, send me the money, I need some money.
Would that be in the cash equivalent?
So then it would be liquidate your investment and go into your cash, yes. So the investment could still be a short-term current liquid asset. You know, the endowment down there is definitely long-term. Permanent.
Yeah, there's something that's gonna prevent it from being converted to cash within a short period, and yeah, long term.
Yeah. But I think on that balance sheet, the biggest thing is that, you know, you have this promise to give, that's a receivable. You have a lot in receivables. You know, that would be grant receivable 7, 8, you have 26,000 on the balance sheet. Of receivables. Okay, which, you know, that's. And if you take away the line of credit, you only had 10,000 in cash and a lot of receivables, so it's probably more of a cash flow.
So would
Receivables are converted,
would a certificate of deposit be considered cash equivalent or an investment?
cash equivalent, but I don't know why it's called investments, but I would say you can still get to your. If you have a, you know, a small investment portfolio, you can get to it the next day.
Maybe it's like interest earned off of investments?
No, that would be in the investment account, the balance of the entire, they're calling it investments.
It could just be stock, right?
And so it could be stocks, it could be.
Stock that you could trade tomorrow if you wanted to, but it's.
Exactly, it still can be converted. The thing is, if you look at their revenue, you're not looking at investment gains and losses, so I would say.
So then what would be considered a long-term investment?
So a long-term investment would be something that you're using the organization to grow. Okay, so maybe it is an endowment, maybe it is a cash reserve that you want to invest for a future growth in 3 to 5 years, the 24 months of revenue that you've accumulated that you want to put towards a future expansion. And you're investing that in a long-term, whether it's a cash or cash equivalent, but you're showing it as a long-term investment to be used.
Yeah, if your expectation
Is
is that you're not going to have it
Right,
in the current year, then you would show it long term.
that you're building.
So it's really a subjective thing as to the category of these things?
Yeah, it is a statement of intention
Yeah,
and expectation.
I guess it would, the only reason I mention it is because it would change the current ratio.
yes, you're right.
But if the stated intent is not to tap it, yeah, that would not, you couldn't.
Right.
Could consider that liquid.
Yeah, I'm looking at how liquid it is more than.
Yeah, whether it goes long term or short term is a prediction of its liquidity.
And the board can restrict it, and the board can say this asset is restricted, it cannot be used for short-term, you know, and so then you say, okay, well, what do we do when we're in a bind? You know, then it becomes a board decision to tap those long-term assets.
Let's do the 990s.
The short one, yeah, it's done. The postcard, it's done. Let's see here. So, you know, besides, your current financials and everything else, one of the biggest things in compliance, and we do look for this on our grant cycle too, is that have you filed your 990? The IRS, this is a public document, by the way, and I will just give you a note or a tip here on your 990 for those that file this report, because it is a public document. Okay, that it must be readily available to anyone that asks for it at the organization. The IRS does put these, if you go to IRS charity check, you can find another organization's 990. They're usually about 3 years behind. Charity check, charity or Guide Star will have a current, they'll also get that from the IRS and post that. But one thing to note on it, that if the IRS, the public copy from the IRS does not include Schedule B, which is a list of donors. Okay, which is, you must file that. Any donors usually over 5,000 or a percentage of your total revenue, and you list those donors. The IRS requires that, but as a public document that is must be available to anyone who asks, do not include that. That is not a public copy. It actually says on Schedule B, not for the public. So just remove that from your actual 990 when you post it on your website. It is also a good thing if you do have a website to put your 990 on it, because it is a marketing tool. If somebody's interested in finding out more about you, they don't want to have to say, gosh, I wish I knew more about them. Let me look at their 990. And if they have to ask, you know what I mean? And you say, oh, well, let's see, I'll ask my accountant, I'll ask my bookkeeper. If you have a website, put your 990 out there so people can go and actually look at your organization. It's a great marketing tool. Also on some of the other, besides being compliant with, you know, that you must file this with the IRS. There are some of these things. Use this report besides the financial numbers and stuff. When there's on the page 2 this is where you can shine on your organization. When you report your programs, what you do as an organization, this is your time to shine and to use that as a marketing tool. So if somebody's looking at donating to your organization, they want to see how strong you are. They're going to go to the page 1, which is your financials, current year, prior year. They're going to go to page 2 and say, what do you do? And if you just say, you know, I have an example of a poorly one that just says, we help cats find home. And I'm looking at this deals like that's all you do. It's taking $500,000 a year to rescue cats, and they just help cats find homes. It's like, that doesn't tell me much about your organization. But if they go into detail and say, we've helped, you know, neuter, spade, you know, find homes and rescue and, you know, the elderly with bonding with animals, and you go through this whole thing, you go, my gosh, this organization is fantastic. So use that as a place to put what your organization does. Okay, it's a marketing tool. You get to put that, and then you'll follow up. Anything that you can't put on page 2, you can put on Schedule O. And so when I'm reviewing a 990, I look at page 1 and page 2. I'll look at the directors, see, you know, who's on the board. If there are any directors to the organization, and officers, right, to Schedule O. And I look at all the exceptions, and that is where you can put anything you want on Schedule O.
Got a question from Elizabeth online, Karen.
Okay.
Yeah, I was just curious, how often do organizations usually file the 990?
It's an annual requirement.
Okay.
So yes, it is required to be filed annually. Thinking it's March, but we usually file with an extension in July. So if you're registered in the state of Colorado and you file a 990, you need to update your registration with the state of Colorado with that information from your 990. And that deadline is like August 15th annually. So these are.
You have a follow-up, Elizabeth?
Say what?
You have a follow-up question?
No, that was it. Thank you.
So is there a short form of a 990?
There's under, just don't quote me on this, I'm sorry, under 50,000, it's a postcard. It's really quite simple. You just, you know, mail it in. Under 200,000 in revenue, and I believe there's an asset also if you have more than I have those numbers wrong. Maybe it's 200,000 in assets or 500,000 in revenue. Then you require the easy form 990. You might.
Yeah, we've been filing the postcard, so for these marketing reasons you just explained, is it an option to file the longer form?
You can, it just requires a little more work. There's a lot more pages
Right,
than
but
one page.
there may be an advantage to doing that.
You can go look at the short form 990. Which actually gives more details. And that's one of the things too, that if you don't file a 990 and you want to show the organizations or people that are looking at your website and your organization, can you provide some management approved financials or an annual report of some kind that shows those numbers? You know, that's been approved by management, so someone can actually look at what your organization is doing.
I'd say beyond, you know, yes, the 990 is potentially a marketing tool, but if you qualify to do the postcard, there's other ways to get your story out there on your website. GuideStar, which is otherwise known as Candid, has some options for data entry on your record there that a lot of funders will use to research your organization or donors. So there's other ways. The IRS is fairly limiting on, for instance, like what is your primary service area of your organization? They're gonna, when you first apply for your 501c3, they're gonna categorize you as one thing, and it's pretty hard to change that. With Candid and GuideStar, you can check multiple boxes for the types of services you provide and all. So I don't know that I would suggest making, you know, taking on that extra effort and expense just to have a little.
But if you're getting close to that and your organization is growing and you're going to be filing that, you might want to look into that. And there also there's other pages in the 990 that, and I think, do we have a handout on internal controls? Yes, in front of everybody. Yeah, and so that actually, you know, looks at when you start answering those questions on the 990, says, does your organization do this? Does your organization have a whistleblower policy? Does your organization have a conflict and confidentiality policy? And if you say no, 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 you know, it's kind of like, why not? Okay, so that would be maybe until you develop those. But it's also going through those governance questions on the form, you know, is to look at those questions. And this handout that we have in front of you, internal controls, is another kind of a checklist of questions that you should be asking. And it's the same thing there too, is like, you know, have maybe your executive director answer those questions, have your board answer those questions, and then compare the notes and just say, does your board know what you're doing? You know what you're doing. So it's just one of those things too that should be plugged off in 990. On those governance questions.
And I have seen our grant reviewers here at the Community Foundation pick up on that, and specifically ask about why does this organization not have a whistleblower policy? That may or may not be legally required of you, but it's definitely best practices for every organization to have one. So even though it looks like a long list of yes, no questions, and eyes might glaze over when you look at that part of the 990, what Karen's sharing is, it does actually have some practical relevance to, for instance, a grant application.
I'm not sure how much it applies to everybody, but just a process question. So for our organization, we're all volunteer. And our formal address is a post office, but we don't have a place to live. And then we have turnover on the board, and we forever fight. Who does the 990 go to and who has the right password to log in and fix it? Because as our board responsibilities change on an annual basis, it's hard to keep up with. So is there a best practice that we can't just put our name in there because the government won't accept a post office box as a physical address?
So that's where you have to go to, used to be Postnet. Now it's the other
Okay,
place that they will actually use that as a physical.
and use that as the physical address to get around that? Okay.
That's one of the, that's another way, and you can use that for your registered agent, or something for your organization, but that's a way to have that physical address. Technically, they would sign, I don't know what it's called. It used to be Postnet that we used, and actually maybe mail, West Store might offer that also. Physical.
Omni Graphics.
Yeah, that's it, the new one, yeah, so they might check with that. Yeah, and to kind of, do that, so you have that physical address, which is also a mailing address. Get around. But it's hard when you say, so whoever is the volunteer executive director and the volunteer treasurer probably needs to be responsible for those. Yeah, unless that changes.
It does change.
Yeah.
A lot.
A lot.
And it's not easy to change when you go in and do this 990 postcard.
Right.
It's not obvious how to change or to update who these
Or
responsible
a
for.
contracted, possibly to enlist a contracted accountant that would be more stable to provide that service. Or as a physical address. Might be.
Well, what we take away is that financial statements are tools to help you manage your organization. You're looking for trends, you're looking for variances, you're looking for anything that's odd, that was unanticipated in the budget. None of this is right, wrong, or otherwise. It's just a way to ask intelligent questions about your organization and look for ways to anticipate problems or anticipate opportunities. Your bookkeeper is not your level.
No.
Yeah. The financial statements are full of messages and clues that will help you. And so you want to see them every month, have them reviewed on a rigorous basis. And your board should be interested. And I think you should have a little questionnaire about when you signed up, and I think there were a few indications that the board was of your particular organization, not naming names, was not taking an active interest in the financials. That needs to be addressed. That is critical to their duty as director.
Survey for.
Yeah, it's gonna be emailed out, yeah. Oh, we got a quick, yeah.
I have a question as far as detail. And the examples that you gave seem very simplified, and I think that would be helpful, like in a grant application. But as far as like line items and breakdown, should the whole board be reviewing every line item, or would that be more of like the finance committee that is a line by line?
So, yeah, so if you have a finance committee, I would do the very detailed, okay, for your finance committee. And to go through all those different line items, to really get a good idea of where you're going. And then, when we present to our board here, then I consolidate it so that the board can easily understand, instead of looking at your operating expenses and you got 50 items, they just see wages, office expense, building, so there's just a few categories. So it's condensed for the board, but I go through this in detail with the treasurer before I condense it and send it to the board. And so.
And then as far as like a grant or a donor, you condense it.
You condense it.
Absolutely.
Yeah, and if they ask more questions, then you have the breakdown, but definitely to keep all those details, for internal, that's what we call internal financials. You share with your subcommittees and then condense it, because we do see some that are like 18 pages from QuickBooks and 50 different events, and we're like, oh, and so it's kind of like condense and say events, okay? And we understand that internally you want to track everything, but it makes it very hard to read a financial when it's 50 pages long. You know, and stuff, just to condense them into categories would be awesome.
Just real quick, since you had a special line about your bookkeeper is not your accountant, so if we have a tax person, that considered our accountant?
So I would say, so your bookkeeper kind of does the transactional work, you know what I mean? They're, you know,
You want me to throw this up?
they're booking revenues and expenses and everything else, right? But within your organization, whether it's your treasurer, the executive director, should be reviewing those transactions. Number one, that they are posted to the correct budget line items, reporting the revenue correctly and stuff, because that's just transactional. So then you get to your tax accountant. Are they going to actually look back at your financials?
So accountant is referring to executive director.
More of the financial, right?
It's like all those different roles that are doing the accounting, the bookkeeper's just putting it.
The bookkeeping is just doing the transactions, somebody doing the accounting, financial functions.
Yeah.
Okay, an accountant, you know, I'm not a CPA, I call myself. Yeah, used to be a bookkeeper, you know, but anyways, but accounting, okay, so they're doing the accounting, they're overseeing the bookkeeping, making sure everything is in the proper categories, booking it correctly.
Okay.
You know, in the right budget items, and then presenting that. And somebody on your board can be acting as that accounting person.
Okay, I just wanted to make sure I was understanding the accounting part correctly.
Yes.
All right, look for a survey from the Community Foundation as a follow-up. We would love your feedback on this for the presenters, for us as a community foundation offering these educational series. If there's questions that we didn't get to today, feel free to email either Camille or myself.